Seems like traders are just waiting to see whether we get a catalyst or tariffs. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, it's anything but a quantum leap. Quantum computing stocks tumble after NVIDIA's CEO predicts that useful machines are still decades away.
And Albertsons raises its earnings outlook for the year, a positive sign for the grocery chain after its proposed deal with Kroger fell apart.
And rising cases of bird flu giving wings to Moderna shares, at least for today. Moderna is one of only a few drug makers that's actually developing a vaccine for the disease. All of that and more coming up. Let's take a look at where these markets are trading after an absolute wipeout in yesterday's session. You can see a little bit of a bounce back. It's been a choppy trade so far this morning. We had ADP actually miss headline estimates, but then we had claims come in lower than expected as well. So a bit of a mixed bag as we head into Friday's jobs report. A little bit of green on the screen, though. You can see the 10-year Treasury yield right now unchanged, but we are very, very close to 470 right now. That would be the highest level since April, and a lot of strategists and bond investors taking a look at 5% as a buying opportunity.
Yeah, the longer end of the curve, I think, is shockingly high right now. I got this chart from Valerie Titel in London via Dan Curtis, our producer, and you can see that we're not quite up to the cycle highs. This is the 10-year and the 30-year yields. But when we get there, it's going to be the highest level we've seen since the Great Recession. So that puts into perspective really how high yields are, and the market has to deal with that.
Absolutely incredible. Jim Bianco says we might retest and beat that 2023 high. So something to watch for in the near term.
He's a Michigan fan, so.
Okay. Rivalry. I don't even know what that means, but we will find out. Anyway, some stocks we are watching. Albertsons raises its profit guidance in the first earnings report since a judge blocked its $24 billion deal with Kroger, yet comparable sales growth slightly missed estimates. Market likes the projection, though. Albertsons up 1.5%. Rigetti Computing. This is one of those quantum computing stocks plunging after that comment from Jensen Huang, NVIDIA CEO, about a 20-year timeline for mainstream adoption of the nascent technology. We're going to talk more about that, but really taking a hit, down more than 26%. Moderna up 0.5% pre-market after a 12% gain on Tuesday. Scary stuff. There was a bird flu death reported in the United States. Moderna is one of a few drug makers developing a vaccine. We're going to discuss that later this hour as well.
Yeah, Katie's kind of obsessed with that story,
I am.
We're definitely going to talk about it. But first, economic data pointing in slightly different directions, right?
Yeah.
ADP was less than expected, and initial jobless claims also lower than expected. But that's so
signaling strength.
Bad news and good news.
Yes, very true. There's a saying out there, never trade on ADP. So, of course, the correlation between ADP and NFP is fuzzy at best. So we'll see, of course, if the action we're seeing this morning follows through on Friday. I thought it was interesting, though. There was a note out from Citi, friend of the show, Stuart Kaiser, saying that if you take a look at the options rate market right now, it's priced for a 1.2% move in either direction following Friday's report. So fireworks expected.
Yeah, what's interesting to me is we've talked about this, 1 basis point here, 1 basis point there, 6 basis points here. It brings us closer to 470 nearly once again. And the worry for Friday was that an overcorrection? Because once we hit 4.7, 4.75 is the one Julian Emanuel is watching for over at Evercore ISI. Also 5% as you've been talking about,
Well,
Katie.
if we get a miss, I mean, I would imagine we'll see yields drop like a stone, just given how far we've come.
More than 1 basis point.
More than 1 basis point.
Which is like?
Several 1 basis points moves.
But 1 basis point is like?
It's like a sneeze on the keyboard.
There you go.
Levered, though. It could be painful.
All right, I want to bring in our first guest. BMO Chief Investment Strategist Young Ma joins us now out of Dallas. And I thought your note was fascinating because it kind of sets up in my mind a game of chicken. Do we get a positive catalyst for the market? Do we get, earnings growth coming in or something from Jensen Huang that makes us bullish again before we get tariffs or mass deportations from Trump that freak us out and drive yields even higher? What do you think?
Well, thanks. It's great to be here. We do think that's kind of the push and pull right now that the market is going through. On the one hand, there's concern about tariffs. There's concern about rising treasury yields, sticky inflation, what happens in the labor market. And we're also looking at what are the catalysts? What is earnings season going to come in like? And what's going to provide the next leg up? In the short term, we think the market probably has continued to be poised for a dose of caution because the risks just look like they're presenting more uncertainty for the market and tilted toward caution and profit taking at this point. But we do think catalysts will be coming. It's just going to take a little while here.
I want to talk about the relationship between the bond market and the stock market right now, because that's all anyone wants to talk about. It feels like there was a really interesting note out from Goldman talking about so far stocks have been resilient. But if you take a look at this current move in the 10-year Treasury yield, it's very reminiscent of what we saw in 2023, in 2022, periods that proved to be very painful for risk assets. How are you thinking about that relationship as we exceed, in some cases, 4.7%?
Well, those are good analogies and corollaries because in October of 2023, we did see the 10-year Treasury yield rise just above 5%. It's probable that we think that level will be breached again. But if we look back to that time, it was actually a buying opportunity for both stocks and for bonds. And we think that probably a lot of the concern right now is a short-term concern. We don't think those 10-year Treasury yields are going to get to, say, the mid 5% range and stay there. We do think it would take a higher level than is currently anticipated to really cause lasting damage in the equity markets and the economy. So we think right now there's a lot of concern, but the underlying economics to us don't point to a sustained move and level above 5%. We think we could get to about 5%, stick around there for a while. But we think right now, this risk, which had been underappreciated by the market for quite some time, is now probably being actually a little bit overblown by the market here and could present a buying opportunity.
You know, one thing I'm interested about, too, is portfolio construction. Katie made this point a little earlier about potentially buying opportunities at 5%. You are definitely seemingly agreeing with that view. But how much fixed income? You have Vanguard coming out this morning saying that a 40-60 portfolio, not a 60-40 portfolio, but instead 40% in equities and 60% in fixed income could make sense at this juncture. Would you go that hard into a trade like that?
We're not recommending that to clients. We do believe that taking equity risk this year is still a favorable positioning. We certainly bonds have a place in portfolio, provide stability. We think we're on the verge of getting better yield pickup. We've actually been short duration for some time here now, and actually relatively light on our fixed income positioning, which we think could be more attractive in the coming months if we get higher yields here. So we wouldn't take that kind of tilt. We do think as the year plays out, there's going to be better opportunities to see gains from those riskier assets. But in the short term, there's no question there's a dose of caution. There's concern about these treasury yields, how high they can go, and thinking about what happened when the markets saw 5% yields in 2023 is giving people quite a bit of jitters here.
But is it correct, Young, to say that you think the concern, the risk of higher yields is overblown? Because I can imagine it being a longer-term issue, right?
Yeah, we would say the risks are overblown. If we think about what the underlying economics are, we have inflation at maybe 2.5%, let's say even say 3%. If you tack on another 1% real yield on top of that, another 1% term premium, you're looking at something that's likely below 5% for equilibrium level for the 10-year Treasury. So we think these levels are sustainable for the economy. If you look back to 1995, where were Treasury yields in 1995? We had short-term yields around 7%, the 10-year Treasury in the upper 7% range. This is a level that is digestible by the economy. It might take some adjustment, recalibration, but it's not going to derail economic growth. You're going to have strong productivity gains this year, and that's going to all start to kick in and be apparent in the second half of the year. But we could and are likely to have volatility before that.
Yeah, great context there, of course. Treasury yields in 1995. I know Matt was paying attention, but many people weren't. Let's talk a little bit more specifically about the tech sector, because you think about the stock market, so dependent on the tech sector. And you write in your notes that it remains a winner-take-most economy. So we believe mega-cap tech will hold up well. Talk me through that. Why does winner-take-most translate into big tech gains from here?
Well, these mega cap tech companies have just built such strong moats around their business, and the ability to have deep pockets to fund the new technologies and really be on the forefront of technology and even buy up smaller companies that have other technologies that are useful is really a tremendous advantage at this point. And we think these companies are well positioned. There is some concern that perhaps some of the investments they're making, the CapEx, has a longer payoff timeline. And certainly there are some notes out about that where some investors, some strategists are concerned that the market might have a bit of a hiccup because of that extended time frame for the return on some of these investments. But we think these investments are so crucial to the economy, crucial to future tech spending and growth and productivity developments, that we think ultimately the markets will be comfortable with this level of spending, this level of investment, and these companies just have such a strong business that overall we think they'll continue to hold up and lead the market pretty well here.
BMO Chief Investment Strategist Young Ma, good start to this year, of course, drumbeating to that jobs report, looking at where yields will impact the markets. But we're going to discuss more on that technology trade. We're going to talk about quantum computing, though. Stocks in the industry are having a moment. They were for a few months now, but one comment from NVIDIA CEO sending the shares of those companies off base and pushing those companies lower. We're going to talk about why next. This is Bloomberg.
Getting out of high interest, look at what's making headlines around the world. Wildfires tore through the Pacific Palisades area of Los Angeles. Homes were destroyed and about 30,000 people were ordered to evacuate after a brush fire erupted in the community, causing panic and traffic gridlock, with some people abandoning cars without leaving their keys in them on narrow hillside roads. The blaze has spread to almost 3,000 acres and remains uncontained. President-elect Trump is asking the U.S. Supreme Court to step in and stop his hush money sentencing from going forward. The sentencing is currently scheduled for Friday, like this coming Friday. The filing follows a verdict from a New York judge who rejected Trump's argument to vacate the 34 felonies in light of his presidential victory. The judge who oversaw the trial has said he won't sentence Trump to any time behind bars. And Bill Ackman's trade idea still has the market's attention a decade later, scooping up shares of Fannie and Freddie. The founder of Pershing Square posted last month about a bet on the U.S. government unwinding its massive stakes in those companies, acquired as part of a $190 billion bailout during the GFC. Ackman is eyeing a profit, or forecasting a profit, of 1,200% on the investment. Meanwhile, the shares have already soared by over 200% since the election of Donald Trump. The re-election analysts warn investors to approach the trade with caution.
We're now going to turn to a more nascent industry, of course, quantum computing. It has struck the fascination of investors, but shares of stocks linked to the next level computing technology are plunging today after months of bullishness. This comes after NVIDIA CEO Jensen Huang told analysts that quantum computing is likely 20 years from going mainstream. Bloomberg Technology co-host Caroline Hyde is here to explain. One thing I did to really put some context around this is go back to Alphabet and what happened in early December here. The lead of our own story on this talks about, okay, fine, they have a quantum computer needing just 5 minutes to solve a problem that would take supercomputers around 10 septillion years. That was the exciting part.
Longer than the entire existence of our universe.
But the next sentence...
By a long shot, like exponentially longer.
Right. So there's the promise. The next sentence was Google's next task was to find an actual use for that superpower.
Yeah.
So aren't they saying the same thing?
But it is interesting that Google quantum AI team have said we're going to find something relatively useful in 2025. Whereas here comes Jensen downplaying what stocks have actually risen about 1,000% in the last year, I might add. So coming off about 20% ain't much. But dousing a little bit of that euphoria, saying, look, it's going to take 15 years until we get something incredibly useful, 20 years until we get something significantly useful. And NVIDIA, in theory, should know, because NVIDIA has been working with Google Quantum AI to simulate the use of hardware, of chips that are going to be necessary in the use of these supercomputers. We haven't got the hardware yet to really overcome the significant limitations. The big breakthrough, the Willow chip, which is made by Google, is that it does help reduce errors, cancel out the noise. This was some of the significant issues that have been limiting quantum computers thus far. So maybe there's a little bit of, I don't know, bitterness or even a little bit of competitive streak, feeling that Willow chips got there. But ultimately, Google's using NVIDIA to help simulate, to help identify the ways in which they have to build chips and hardware. So if anyone knows, Jensen should know as and when quantum computing really comes to bear.
Well, 2 points there. I mean, Jensen did say that 15 years for very useful quantum computers. So who knows what very useful means to him. But that's what I was going to ask. I mean, is this Jensen talking his own position because NVIDIA isn't ready for prime time and sort of talking back the market? Or is this really, do you think, an honest assessment of where this industry actually is?
Are you asking me to say whether a CEO is honest or not, Kate? I mean,
exactly.
I have to just say that thus far, the guy's been honest. He's taken big bets very early. He saw generative AI and the need for GPUs and AI and applications of his own technology far before anyone else did. If he's going to see round corners, I would bet on him to be able to do so. And I haven't really seen something authoritative. When we had Google Quantum AI chief on, he didn't say, yes, we're going to have a breakthrough in necessary quantum computing that's going to be super useful in the next year. They're just going to start to find the applications. So perhaps they're actually singing from the same hymn book here. It's just the market got ahead of itself. We, the retail investor and the institutional investor, powered up these particular companies, these smaller quantum-related stocks, to the tune of thousands of % on the hope that maybe we're going to have a breakthrough in the next year and the year after that. Funnily enough, maybe the market's just getting ahead of itself.
You point out that some of these stocks have already risen rapidly. Qubit, QUBT is the ticker, is up, what, 1,900%? Rigetti is up 1,500%. But these are still just only 2 or 3 or 4 billion-dollar companies, right?
And their revenue, I think Rigetti, they have a 3 million per quarter revenue. Yeah. These companies are so early doors in what they're going to be able to provide in terms of useful application of what they're building, that many are just pumping them up on the hopes that they'll have a key breakthrough in the next 10 years. NVIDIA. No, these are kind of like biotech stocks. You either win or you lose.
Yeah.
Well, yeah, let's even take an even bigger step back. If we're talking about Rigetti, $300 million, what is useful? You know, going back to Katie's earlier question, useful today, what would show progress over the next year, even if you believe that the biggest of gains are going to come in 10, 20 years?
Yeah, and Bank of America did a good job at trying to point out where would quantum be useful. Drug discovery, most prevalently. Actually, generative AI is where it's going to be deeply useful because we're going to be able to be speeding up the way in which we train data and inference. But that is unlikely to be coming. And I think Bank of America are like, yeah, and that's going to be occurring in the next couple of years. But in the longer term, what is going to be useful in the here and now is continued breakthroughs when it comes to these chips, when it comes to actual cancelling out of the noise. Basically, the fact that it's incredibly difficult to basically use the hardware as it currently stands. It can only run a certain number of, I don't know what they're called, quantum operations, so to speak, in a certain amount of time before the noise just gets too much and you start to not get accurate results. So how can we understand that? How can we ensure that ultimately when you're holding these things at freezing temperatures to be able to allow some of this quantum physics to even allow to be working, how do we overcome that? How do we store it, make it also scalable? Because this is expensive to hold temperatures at such a level.
Well, I want to get the investor perspective here. There's at least one ETF that tracks this industry. Yes. The ticker is QTUM. It's an ETF from Defiance. It launched in 2018, so it really was ahead of this wave. Obviously, it had a fantastic year last year. It took in $500 million, almost a $1 billion ETF. Even with Jensen Huang coming out and pouring some cold water on this craze, I mean, how excited and interested are the investors that you talk to on BTech about this industry?
Well, we had Sylvia Jablonski, who's behind Defiance, the ETF for quantum, on. And look, she's actually saying it. If you look at the performance of the ETF, it underperformed the likes of Rigetti because they have to iron it out by ensuring they've got diversification, by putting the likes of IBM, Google in, people who are actually at the forefront of building some of the supercomputers, not just the penny stocks or the now the dollar stocks that you see. and she really is saying that this is going to be the trend of 2025. We had a lot of people coming on saying now we've got to these stages within generative AI.
She
now
would say that, wouldn't she?
She would. Well, I mean, but I think she's also betting on all other areas of innovation. Yeah. So maybe she wants to continue to see the inbound into her ETF. But I think she was realistic that you've got to bet on some of the bigger players, not just some of these smaller stocks.
Yeah,
she's a great guest.
She's great.
I've seen her on. What's that show called?
ETF IQ.
ETF IQ.
You remember that? Yeah.
Mondays at noon.
Absolutely. Yeah, they're a thematic issuer, so they are exposed to a lot of the shiny objects, as Eric Balchunas would call them.
You can catch Sylvia on Bloomberg Tech.
You can.
Weekdays
she also
at 11.
has a leveraged MicroStrategy one as well. I mean, she's in on all the hot properties.
Yeah, it's going gangbusters.
Great having you on, Caroline. Thanks so much for joining us. Caroline Hyde there from Bloomberg Tech. Tune into that program. As I said, at 11 a.m. Eastern, Caroline and Ed Ludlow interview CEOs from Panasonic and Mobileye, as well as others from CES in Las Vegas going on now. This is Bloomberg.
All right, welcome back to Open Interest. You can see that little bit of a rally I was talking about half an hour ago. Totally dissipated right now. We're still about unchanged, but the color is red, and that's significant because we saw a lot of red yesterday when it comes to both of these big benchmarks right here. The S&P 500, the NASDAQ 100, not even NVIDIA could save us yesterday. The worst day of the year for both of these, which isn't saying too much given that it's January 8th. You also see some weakness in the small caps right now. The Russell 2000 currently down about 0.9% pre-market. This was your slight outperformer yesterday, but still a big down day for the small caps today, and at least right now we're set up for another down day across the board, across all the size tiers. We'll see how that develops as we get a little bit deeper into the trading action. And with less than 4 minutes to go, coming up as we welcome the market to this Wednesday day of trading, we'll discuss the market moves with JPMorgan's Abby Yoder. That conversation coming up next. This is Bloomberg.
Just moments away from the starting bell. Not a lot of action in futures. We're pretty much unchanged here as we wait to see whether we get some catalyst to drive the market higher or something terrible to bring it down again. S&P futures up 1 or 2/100%, totally unchanged on the NASDAQ. Russell futures are climbing, Katie. We'll talk about that in just...
They're falling.
Or sorry, falling significantly, though. I meant real movement there. Red, green. Take a look at the NASDAQ market site. You've got Principal Financial Group, a fintech ringing the bell there. Over at the New York Stock Exchange, there's some kids. Exodus Movement. It's a software services company. It's small, but it's up in the last 12 months 700%, 28% so far this year to date, and we just started. So pretty good for them. Katie, what do you see in terms of other indexes, sir?
Well, it's exactly what you said, Matt. Not too much to report right now. We do have the colors are red, and we are moving a little bit lower in the first seconds of trading right now from the S&P 500 to the NASDAQ 100 to your small caps. Of course, all of the action is on Friday. U.S. markets are closed tomorrow, of course, for President Carter's funeral, at least the stock market is. So a lot of attention paid to 8:30 a.m. on Friday. We had a mixed bag of economic data this morning, not really a clear picture. Maybe that explains these small moves, at least if you take a look at the large stocks. The small caps, your little guys, the Russell 2000 down about 0.9%. We'll keep an eye on these ones as well. But let's look under the hood here, because we've been talking about those quantum computing stocks really taking a big leg lower after comments from NVIDIA's Jensen Huang. He said that very useful quantum computers are likely 15 to 20 years away from reality. Again, what very useful means to Jensen Huang could mean something to all of us. But in any case, you take a look at Rigetti right now, down about 34%, Sonali.
Yeah, speaking of NVIDIA, let's take a look at the chip stocks at the open, because of course you saw a brutal set of selling yesterday when it came to NVIDIA. You're seeing it relieve itself right now, up about 1.5% this morning. There were concerns about tariffs and inflation. They're all on top of Wall Wall Street's mind as Trump prepares to enter office. But it's interesting, Matt, you still see a pretty mixed trade. AMD still down more than 3% at the market open, but Micron extending its gains another 1%.
All right, I'm looking at Albertsons after spending a significant amount of time in England. I really care about grocery store stocks. Albertsons raised its profit guidance in its first earnings report since a judge blocked the $24 billion deal with Kroger. The company's comp sales growth missed expectations slightly, and you can see the shares down a little bit, but I don't really care about grocery store stocks. I'm just saying that.
I wasn't sure. I would believe almost anything you said, which is pretty dangerous. But in any case, Albertsons down about 12% over the past year. Definitely needs some good news after that merger fell apart. But in any case, let's broaden out this conversation with JPMorgan Private Bank U.S. equity strategist Abby Yoder joining us on set. Great to see you in person.
Great to see you.
So let's talk about drivers of this market right now. One of the narratives, of course, towards the end of 2024 was that this was going to shift away from a macro-driven market into more of a fiscal-driven market. It feels like in the early days of 2025, though, you're seeing every economic data print move this market. A lot of attention paid to Friday's jobs report if you take a look at the options market. How are you thinking about the potential catalysts going forward?
Well, I think to your point, yes, Friday is very important from a labor market perspective. I would say our view on the labor market at the moment is that it's loosening at the margin. It's nothing to be very concerned about, and it's loosening to an extent that allows the Fed to continue to cut. In terms of catalysts in the near term, I think the most important thing really is going to be earnings, which is coming up starting next week. So I think that's something that we're very focused on. I think the consensus estimates are around 12% growth for the quarter. We're slightly above that in terms of our outlook, and a lot of that is being driven by tech and our optimism for tech going into next year.
I'm glad you specified, because when we look at those estimates, one big question I have is you have a stock pickers market once again, and more investors saying to us that you can't even pick sectors anymore. You have to pick stocks within the sectors. So what are the ingredients that you're looking at for companies to outperform here, that growth story?
Yeah, well, so I think to the point on looking within sectors, right? So we're still positive tech, but the way we're thinking about it is yes, we still like these mega cap names, but we're in this we're entering the third year of this AI phase, right? And so we're thinking about different parts of the tech supply chain that are going to benefit in that type of time period, right? So when you're thinking about a data center, for example, thinking about companies that are supplying the components that go into those data centers and that allow data transmission, which is obviously very important and is going to increase as these data centers process more information. And so that's something that we're thinking about. So not just necessarily the mega cap names, but the other names that are going into that build out as well.
If I think about a rally, I have to worry about yields. And I mean, I showed a chart at the top. We're perilously close to 2008 highs in the UK. I think they're there, right? Isn't that a concern? Or I've heard some people paint it in a bullish light. Is it a good thing for stocks?
I mean, it's not necessarily a bad thing, right? I think the way that the market's moving right now, and the way that let's think about it. Let's compare it to the move in yields in the fall, right? And what you saw was stocks actually held in quite well when rates moved that much, because economic data was hanging in. That's what we're getting right now, right? And I would say there is definitely a concern around what's going on with the fiscal picture, right? That's what's really weighing, I think, on the term premium as it relates to rates. But the difference between, to your point, Matt, on the U.S. versus the U.K. is it's not necessarily like a deficit concern in our mind, because you're not seeing the dollar sell off, right? You're seeing the pound sell off in conjunction with rates, and that to us is like a fiscal concern in terms of their outlook. Whereas in the U.S., you're having that decoupling of rates versus the dollar, which is to us signals that the market isn't quite concerned right now. There's some tidbits of that, but not overly concerned.
So if you dissect the drivers, maybe it's not as scary as maybe the 4.7 on the 10-year Treasury yield would be at first blush. But is there any level that would concern you when it comes to the long end, drivers aside? You had a note from Goldman out this morning saying that basically equities have been really resilient during this bond sell-off so far, but that leaves a lot of scope for downside if we get much higher.
Yeah, well, so I think and this isn't precise, but I think there's like probably a psychological level around 5 to 5.5 that would cause some pain in equity markets. But I think what's important, and we incorporate this in our outlook, is right when you're thinking about what is the drive, like why do rates matter to equities, it's really around mostly valuation, right? Mm-hmm. And so in our outlook, we have a year-end target of 6,400. A component of that is valuation compression, right, down to 21 times. And I would say that's probably below the majority of the street in terms of their outlook. And so we're taking into account like those higher for longer rates in that outlook, in that view.
You know, it's interesting. We talk so much about rates, but one thing that's harder to digest, I think, is the impact of the dollar on equities as well, because that's what's been moving very drastically in light of any conversation about trade. Data Track this week said that the nominal dollars index, the gain, is worth 36% of the S&P's relative outperformance since the election. That's incredible. Mm-hmm. I mean, if that's the case, then what would it mean if the dollar were to reverse?
Well, I mean, I think there are two components of the dollar move. I mean, a stronger dollar is not necessarily good for international profits as it relates to these large cap companies. So I would also
domestic investors. Who cares?
Yeah,
right?
I mean, I would argue that like the stronger dollar has been a negative impulse on the equity market. Like I think that's been more of the headwind, and I think it's one of those things that's under the radar because we're pointing to rates. But I do think the stronger dollar from that perspective will be, you know, not obviously a fundamental headwind, but a headwind in terms of earnings for international companies.
Abby, we have to leave it there. We thank you so much for joining us here on set. Happy New Year to you. Can you still say that? Is it too
Larry
late?
David says that you can. January 7th was
Is
the
the
last
cutoff?
day.
Damn, we're a
According
day
to Larry
late.
David, if you put stock into that.
I don't.
I do. What he says makes sense.
Boy,
you know?
is this another debate we're going to put our guests up to? Is what I want to know, Abby. Again, thank you so much again. I want to quickly check on some stocks here because you have eBay just moving higher. It's your biggest gainer in the S&P 500. Meta said it will allow eBay ads on Facebook Marketplace in Germany and France and the United States to comply with an EU antitrust order. The EU ordered Meta to stop trying its classified ad service to Facebook's social media platform, and eBay shares now highest since 2021. We're going to keep you in the loop on all things moving under the hood. Interesting single stock stories here. Now coming up, another one, Moderna stock on the rise as it looks to help another public health crisis. We're going to bring you the details of that next. This is Bloomberg.
All right, welcome back to Open Interest. Quick check on these stocks. About 12 minutes into the session, you can see red on the screen across the board, across the size caps too, because the small caps right now really in the hurt locker. The Russell 2000 down about 1.2%. This follows about an 0.8% fall yesterday. A lot of concerns. Higher for longer. Will they, won't they, when it comes to the Fed's rate cutting trajectory? All of that is being expressed in this index right now. We'll continue to keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Palo Alto Networks getting a pair of analyst downgrades today. Both Deutsche Bank and BTIG said that the stock no longer a buy. The DB analyst expects that cybersecurity companies will underperform this year, while BTIG cites limited upside catalysts for the stock, which is currently down about 3%. Next up, you have Kellogg getting downgraded to a sell at TD Cowen. The firm cites a tough year for consumer staples and says that the company's market share losses and its uninspiring product pipeline suggest that the spinoff has not improved the company's competitiveness in the challenging breakfast cereal category. A very competitive landscape there. Shares down on WK Kellogg about 7%. And finally, with Barclays upgrading Tapestry to a buy. The analyst says that the parent company of Coach and Kate Spade is well positioned to gain market share. Those are some of your top calls, and one stock that we're keeping a close eye on today is Moderna. It's up this week as the drug maker is working on a vaccine for the bird flu. And of course, one person in the U.S. has died from that flu, while there have been over 75 confirmed cases. Here with more is Sam Fazeli of Bloomberg Intelligence. And clearly, shareholders of Moderna and some of these other names are optimistic here, Sam. But what is the actual revenue potential when you think about the avian flu?
Yeah, hi. I'm sorry about my voice. I'm the victim of one of these.
Oh, no.
Sorry.
You're doing great.
A brilliant laryngitis case hit me, so there we go. It's the first time in my life. Nothing to do with COVID, nothing to do with bird flu, just the common or garden virus. So the thing for Moderna is that they have been working on an H5N1 vaccine, so has, I'm pretty sure, Pfizer-BioNTech, and there are already 3 approved. The first one that got approved was Sanofi's back in 2007, right? So let's put that into context. Moderna doesn't have any vaccine approved in this case. Of course, they have a good technology for putting these vaccines out. We do have a case of an unfortunate death in the Louisiana patient. That's the first death ever in the United States from H5N1. But there have been 900 deaths over the past 10, 15 years of circulation of this virus, mostly in developing countries. So there haven't been any in the United Kingdom, etc. So what value this has for Moderna or BioNTech or Novavax, as in my view, is questionable until we see proof, and I hope we never see that there is transmission of these viruses from human to human, which we haven't seen.
All right, Sam, we're going to let you go. Go get better.
Rest.
That sounds painful. That is Sam Ciselli.
Have a hot toddy.
Exactly. Go enjoy that. It's late in London, so that would be acceptable. Sam, really appreciate your insight. That is Sam Ciselli of Bloomberg Intelligence. And speaking of healthcare, next week, I'm excited. I head to San Francisco for the 43rd annual JPMorgan Healthcare Conference. On Monday, I'll speak to a number of CEOs, including Christopher Weber of Takeda Pharmaceutical, also Emma Walmsley of GSK. I'm also excited to speak, of course, to Dave Ricks of Eli Lilly as well. A lot of territory to cover there. But before we leave on this block and go to commercial, let's check in on shares of Boston Scientific. The medical device company said it has agreed to acquire Bolt Medical and pay about $443 million upfront for the 74% stake. You can see shares currently higher almost by 5% or so. Also, coming up, Tiger Cubs delivered in 2024 thanks to tech stock picks such as Meta. We'll explore the results next in our Wall Street Beat. This is Bloomberg. Welcome back to Bloomberg Open Interest. We're taking a look at stocks right now. A little bit of the deepening of those losses in the S&P 500, currently down about 0.2%. The Nasdaq 100 down about 0.1%. The Russell 2000, the small caps, really falling out of bed this morning, down about 1.4% on the Russell 2000. And I think so much of this is tied to what's going on in the Treasury market, particularly when you talk about those small companies. Where you need lower rates is in those broadening out trades, totally predicated on the rate cutting outlook, which of course has been slashed in half.
Absolutely fascinating. Most sectors in the S&P 500 in the red today on the heels of that rate movement. Even the financials, which were largely beloved, but of course higher for longer, means a lot of things, doesn't it, Matt?
Yeah. I mean, look, the Russell 2000, we show often the chart of how many companies are losing money in that index.
We certainly do.
Right? And so interest rates really matter to at least 40% of the index. And right now, the 20-year yield is over 5%.
God, you love that yield. That's going to be
It's focused in on the 20s.
That will be the benchmark. You're going to will this into existence.
You know, we're going to need to start citing the S&P mid-cap 400 at this point, too, to start to get a gauge on how these mid-cap stocks and small caps are doing. All right, we're going to switch gears. We're going to talk about the big guys. It's time now for the Wall Street Beat. More hedge fund returns are rolling in, notably Tiger Management. Gained 24% last year, with Meta as biggest position for tech-focused stock pickers. Meta shares climbed 65% in 2024. We're going to discuss this with Bloomberg's Hema Parmar. Interesting. Tiger Cubs coming back again. Have they kind of gotten over the high water mark here? Because they had a lot of pain when we saw the drawdown in valuations. But big tech, really interesting. We know they've all been taking different strategies into how they approach the Mag 7 even.
Yeah, so it was a really tough 2022. We saw numbers we really haven't seen before. Some have gotten out of their high watermark, some haven't. So if we look at Viking, for example, they're a fund that didn't lose nearly as much as their peers. They bounced back off their high watermark pretty much the year after. But this is the first year for Co2, where they bounced back from their high watermark. If we look at Lone Pine, they're close. They only have to make about 4 or 5% more to get over that. But Tiger, they had the worst performance, and a lot of these guys had 2 bad years back to back, 21 and 22. So they still have to make about 50% more than they have. That said, they have bounced back a decent amount and posted double digits for 2 years. So investors are probably happy with that, but still a long way to go.
Is the common denominator for all of these names that did well big tech? Is there anyone who wasn't overweight some of these big tech companies that we talk about all the time that also performed?
Yeah, so all the Tiger Cubs, they made most of the money. I mean, they focused on tech, so their games really came from tech, and Meta was their biggest position pretty much across the board. But there are some other equity stock picker funds that did make money without necessarily being an NVIDIA or Apple or Meta. So let's take a look at Contour. They're a $3 billion hedge fund. They're up about 47% so far this year, mostly because of their short book. They were not in NVIDIA or Apple. Then if we look at Rubrik, they were up 81%. That's because of an energy bet that worked out really well for them. They were in Taylor Energy, and that stock more than tripled during their investment period.
What does investor appetite look like for the Tiger Cubs? I mean, I'm old enough to remember Julian and how important these investors were on the hedge fund scene, but that's because I'm old, right?
He quotes the Dow, that old.
Exactly. So do the kids still invest with these guys? Are stock picking funds all the rage right now?
Yeah, so stock picking funds are the most sought after strategy, according to a Bank of America report. They are the hottest one right now of the space. But I do think when you look at Tiger Cubs, you want to look at them a little bit differently because they are so tech focused, because so many of them have really gone through a trying period, and because they do a lot of private venture as well too. So whether investor demand has come back for those funds, we didn't really see a lot of appetite for Tiger's latest venture fund, for example. I think they're still trying to ramp up across the board, all these funds, and I think investors are watching very closely. I wouldn't call them all like the hottest funds just yet, but equities as a broader strategy is in hot demand.
Has there been no reputational damage over the past years from the various scandals and, massive jail time that some of them have gotten?
Hedge funds broadly?
No, Tiger Cubs.
Tiger Cubs. He's referring to Archegos.
Oh, yes. Well, that's a family office. So,
right, no, but Huang was a Tiger Cub, right?
Yes, yes. Yeah, I mean, I think...
And he got in trouble before Archegos. That wasn't his first brush with the law.
I think a lot of the reputational damage has come from just pushing so fervently into private equity and tech at a time when it was just not opportune, and kind of getting over your skis on some of these venture bets, having it blow up in a big way, having that pain across the board. And I think that has really soured people to having too much exposure and concentration into some of that exposure.
But it's a crossover model, and that's what really was pioneered by these Tiger Cubs in the recent years. It looks so rosy. Tiger Global, Co2, is that crossover model where venture is being sought after, is it dead yet? Because we're on the precipice, in theory at least, of an IPO rebound.
Right.
This would be the time to cash out of some of those trades.
So that's the thing. Yeah, you know what? This could be the time to be really investing in the space. The problem is a lot of allocators already invested very heavily in the years before, so they got burned. And they have less capital to put to work, and they have less redistributions from PE. So when they're looking at where to put their next dollar, they're really thinking, okay, do I put it in a hedge fund? Do I put it in more private equity or more venture where I'm already overexposed? Yes, for managers that have not had that exposure in the past, this is a great time, and we've been seeing that push in, but so many have their hands tied.
Emma, great having you on.
Thank you.
Love talking about this. Old school is new school kind of stuff. They're back. Hema Parmar there covers hedge funds for us, and Sonali obviously does that as well. We're looking at some, I guess, a tech stock right now that's moving a lot this morning, eBay.
This is fascinating. This is the biggest move since 2021 for eBay.
And so do you ever use eBay?
I don't. My husband does a lot because he likes to search for old cameras that you can't find that easily.
Well, I can tell you that because I've sold a lot of stuff on eBay lately.
You seem like the type.
They have this new promoted ads thing where they take another 10, 12, 15% from the seller. And so if they get their ads in more places like Facebook, they can raise fees drastically.
And you can thank the EU for that. Anyway, coming up in the next hour, Wolfe from Morgan Stanley Wealth joins us to talk ahead of Friday's jobs report. This is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, second term unchained. President-elect Trump floating a number of headline-grabbing ideas, including seizing Greenland and absorbing Canada. We're going to give you the context.
And it was a milestone year for Rolls-Royce, not because they're selling more cars, but because they're selling more expensive, super high-end, bespoke cars. The CEO joins us later this hour.
And it's still all about NVIDIA. CEO Jensen Huang's comments still making waves in the markets, particularly in the quantum computing stocks. Ed Ludlow joins us from Vegas with the latest later on this hour, following his interview with Huang yesterday. But let's get to these markets right now. Volume a little bit higher than normal. You can see a sell-off developing in the S&P 500 right now, down about 0.2%. It's been a rough 2025 so far, of course, for the stock market bulls right here. The NASDAQ 100 unchanged, big tech trying to be resilient here. We'll see how long that lasts. And the bond market holding in steady right now. We are pretty much unchanged on the 10-year yield, but the levels are eye-watering. You can see the 10-year Treasury yield right below 470. These are the highest levels since April or so. And of course, this comes after this morning's jobless claim data. It came in a little bit softer than expectations, below expectations. That's good. But then you had ADP also miss estimates as well, which would signal some weakness. And all of this comes before, of course, Friday's jobs report. So let's get to the latest now with Mike McKee, of course, joining us from Washington. And Mike, talk to us about what ADP says about NFP. I say this every month, but the mantra out there is never trade on ADP because it's hard to draw a line between those two figures.
Yeah, well, nobody's listening to you, Katie, because everybody trades on ADP. I think they just trade against the forecast for the number, and the number came in much lower than even forecast. Forecast was for 140. ADP came in at 122 for the month of December, which is extraordinarily low. Now, we also saw, as you mentioned, a good number for initial jobless claims, 201,000. But the issue there is that's largely seasonal effects. The seasonal adjustments expected a bigger increase in jobless claims. We didn't get it, so they pushed it down farther to 201. I think you take that with a grain of salt. But the ADP one is interesting because you go back and you look at what happens with ADP and non-farm payrolls, the private sector payrolls, and they don't match up at all. And ADP has now gotten to the point where they tell us they are not a forecast for the private sector payrolls number. As you can see there, they don't match up. They kind of go in the same direction. The red line all the way over on the right is what the forecast for private sector jobs is, and it's above where ADP is now. Last month, it was significantly higher than ADP. So we'll see what we get.
Every time there's a blowout ADP number, I run over to Mike McKee's desk and ask him to explain this to me again.
And he shows you that chart.
Exactly. Mike, you are not here. You're down in Washington, D.C.
You are right.
What are you doing down there?
We've got the Fed minutes this afternoon, and it's going to get a little more attention than usual in the sense that, you remember at his press conference, Jay Powell said that some members of the Open Market Committee had incorporated the idea of Trump tariffs and other fiscal policies into their forecasts. Yeah. And so the question is, how many did that? How do they explain that? And what can we really take away from the consensus if half the people were using a different kind of forecast than the other half? Markets have been kind of confused by those December forecasts from the Fed, and they want to see a little more explanation if there's enough of one to actually, to get back to what Katie said, trade on.
All right, Mike, thanks very much. Look forward to hearing from you when we get the minutes, and then seeing you back here for the granddaddy of all economic statistics on Friday, non-farm payrolls. Joining us now is Sarah Wolfe, Morgan Stanley Wealth Management Senior Economist. Sarah, you've talked about the fact that some Fed members are now speculating on what Trump policy will do to the economy. They said previously they wouldn't do that, or Powell said they wouldn't do that. Is that why we see rates rising? Is this concern about, tariffs and mass deportations being inflationary and holding the Fed back from cuts? Or is this, U.S. economic growth is strong and so rates are higher?
I think the FOMC December projections make it very difficult to discern what's actually driving markets. First of all, you have about a third of participants that are not including the Trump policies, another third that likely are, and another third that we don't really have a good picture on. The reality is that when you take that all together, some are incorporating the economic data and making their decisions off of that. Waller, for example, spoke earlier this morning, and he doesn't think the Trump policies are going to be as inflationary. And as a result, he thinks there's going to be more cuts. But it's very difficult to discern which policymakers are putting in which dots. Given all of that, we're going to be seeing a lot of shifts in views and a lot of shifts in the SEP over the coming year as these policies actually bear fruit, and it's going to make it very difficult for markets to get a sense of what to believe and what type of forward guidance to latch onto.
Another thing I think that's difficult for investors, Sarah, is that you had the Fed chair months ago saying that politics is not playing into the decision making, but then you see for some of the participants, it is. At least parts of the politics and policy making, trade, immigration. How is that uncertainty playing into interest rate expectations this year?
So the issue is that none of the FOMC members and economists know in reality how these policies are actually going to play out over the course of 2025, right? Everybody's giving their best guess on what the immigration numbers will be, on what the tariff numbers will be, on what deregulation means. But the reality is that nobody knows for sure. So I do feel like what we're seeing in rates markets is kind of the more conservative approach, that this is going to mean higher inflation, fewer rate cuts, and that's why we've been seeing this sell-off in yields and why we're seeing a stronger dollar. But we do need to remember that maybe we shouldn't be taking these policies at face value. Our view is that the tariffs are likely not going to be as aggressive as what Trump has been saying. It's being more used as a negotiating tactic. And so perhaps market pricing of only 1.5 cuts for this year is a little bit too hawkish, and we could actually see less aggressive tariffs, less inflationary pressures, less of a hit to growth, and perhaps 3 cuts instead of 1 or 2.
It's interesting, Sarah. We heard something similar from Fed Governor Chris Waller earlier this morning, saying that if, as I expect, tariffs do not have a significant or persistent effect on inflation, they are unlikely to affect my view of appropriate monetary policy. So it feels like we're all in sort of wait and see mode here. But I want to get your perspective on what's going on in markets, and specifically the bond market, because the Fed has cut by 100 basis points since September. And since September, you've seen the 10-year Treasury yield rise by about 100 basis points. So we're going in opposite directions here. How do you think that the Fed members and Jerome Powell himself are sort of thinking about what's unfolding?
Well, Chair Powell needs to be a bit concerned, and we'll likely see some mentions in the FOMC minutes about financial conditions because of this big shift in policy expectations. And as a result, we've seen a really big sell-off in rates. This has been significantly tightening financial conditions over the last couple of months, and that's not really what the FOMC wants, right? You do see a labor market that's slowed down significantly. It looks somewhat to be stabilizing, but the FOMC does not want to see any more slowing in the labor market, and as a result, they really don't want to see that much of a significant retightening in financial conditions. And so I do think some of the communication that we're going to get is going to help, put a damper on some of that financial conditions tightening, because we do want to be in an environment of less restrictive policy than we were a year ago. If you look at the 10-year, we're at 4.5% right now. A year ago, we were at 4%. That's not where we should be when we're making policy less restrictive. So I do think we need to get a little bit more forward guidance from FOMC members in order to prevent, a retightening in financial conditions, a widening in credit spreads.
I want to ask about the jobs number coming out on Friday, Sarah. Last reading for 2024, the survey shows 163,000 are expected. The whisper number is substantially higher at 185,000. We have a cool function on the Bloomberg, WHIS Go, shows the whisper, and you can even put in your own estimate and see how you fare against your Bloomberg competitors. What are you looking for? And is this labor market really softening? Because those numbers, while not very high, don't seem weak.
I think anything between 100K and 200K is going to be dismissed by markets on Friday because there's so much more attention right now on inflation. And the Fed has made that very clear that they're a lot more tuned right now to upside risk to inflation since the inflation prints have stalled out a little bit. And now uncertainty is weighed to the upside for next year as well. I think we would need to see, some type of material upside in payrolls well above 200,000 or downside below 100,000 to get a really strong market reaction. If we look at the mix of data on the labor market this week, we're not really getting a clear picture. It kind of looks like things are stabilizing. As you mentioned, initial claims are low, but continued claims are rising. But we still have this holiday effect. So I do think even though the hurricane effect, the strike effects that were impacting October and November payrolls are behind us, we're still going to be getting this holiday effect that makes the picture a little bit muddy. So I do think we'll get a little bit of a discounting on the Friday payroll report.
I want to bring up one point about labor markets as well. This is from Neil Dutta over at Renaissance Macro. And when he looks at the idea that labor markets are cooling, and as we know, there's a lot of data that also shows otherwise, he says that he's looking at the quit rates rather than openings because he's looking at a private sector quits rate hitting a fresh cycle low, which also implies cooling wage growth through the middle of this year, he says. So if you're looking at that as one barometer, how seriously do you take it? And isn't some of this kind of okay in that cooling wage growth could also be a decent signal regarding inflation?
Yeah, I think you're making great points there that on one hand, you have openings that have started to rebound and stabilize a little bit. Layoffs are staying low, but quits are low. And so I think as openings start to rebound more and the hiring rate starts to turn, that's when we'll start to see quits rate come back up again. But we're not really, significantly at that tipping point quite yet. And I think this is a good place to be, right? We want to kind of see these metrics being moving sideways at healthy levels where that really is what the quits rate is doing right now. It ticked down a little bit in the latest reading, but if you look more broadly over the last year, it's kind of bouncing around sideways. We're not seeing significant moves higher or lower. As openings pick back up, which will depend a lot on the environment for next year, how much does deregulation actually really help small businesses and support hiring there? That's when we could start to see a pickup again in the hiring rate again in 2025.
All right, Sarah, appreciate the preview ahead of Friday's jobs report. That is Sarah Wolfe of Morgan Stanley Wealth Management. Now, coming up, we are less than 2 weeks away from Inauguration Day, and President-elect Donald Trump has made some bold statements as it relates to foreign policy. More on that next. This is Bloomberg.
Let's get to high interest now. We'll look at what's making headlines around the world, and thousands of people are fleeing the Los Angeles area as raging wildfires are spreading by the most destructive windstorm to strike the region in over 10 years. Hurricane winds blowing the uncontrollable blaze around the region, with the authorities expecting the fires to continue for another couple of days. Mandatory evacuation orders are affecting so far around 30,000 people, while more than 300,000 people have lost power. Indonesia has decided to keep a ban on the sale of Apple's iPhone 16s in place, saying its $1 billion plan that includes building an AirTag factory, Apple's $1 billion plan, is insufficient to meet local investment requirements. The government is willing to negotiate with Apple, but may impose sanctions if the company continues not to comply with local investment rules. And a group of around 20 Republican representatives from the House have been invited to Mar-a-Lago this weekend to meet with Donald Trump ahead of his looming battle to extend the SALT cap. GOP lawmakers from New Jersey, New York, Connecticut, California, they're all expected to push for a more reasonable adjustment to the cap, which currently offers up to $10,000 of relief for the high tax states, but used to be unlimited. So doubling that just isn't going to do it for these lawmakers, Sonali.
Yeah, Representative from New York, Mike Lawler, saying that $10,000 is woefully insufficient. So your congressmen are hearing you, Matthew Miller. Meanwhile, in a press conference yesterday, the president-elect made several bold foreign policy statements, including calling for absorbing Canada, declining to rule out using military force to seize the Panama Canal and Greenland. Joining us now from D.C. to help us walk through all of this, Bloomberg Politics editor Laura Davison. Barring the specifics for a moment here, the tone, how is that being perceived not just from the countries he's talking about here, but also European allies, the rest of the world?
This is really a different Donald Trump than we saw on the campaign trail when he talked about ending wars and very much this isolationist perspective that he took. Now this is very much an expansionist perspective. Almost he's talking about, building an empire in some regards. So this has been met with a bunch of different reactions. For example, in Panama, the Panamanian prime minister said, or president said, look, I'm not going to talk to him. I'm not going to respond to him until he's actually president come January 20th. Of course, that's, he's going to be president. There's no doubt that he's going to have to face some of these questions here in a couple weeks. But you see foreign leaders sort of brushing off and being a little bit flippant with the president-elect. Also in Europe, you're starting to get a sense of real annoyance, both from the tone, from Danish leaders, for example, as well as broadly of sort of, Musk, who has been Trump's right-hand man for the past several months, of, all of the meddling that Musk has also started doing, that there's a broad sense that, that Trump is, kind of coming out in a big bombastic way, and he doesn't maybe actually mean some of these things that he says. With Trump, that's always the difficult line to walk of, what is sort of a negotiating position versus what is, something he actually intends to follow through on.
But there are Laura, I imagine people taking him seriously. I mean, Greenland could be considered a threat in case of a conflict, for example, with Russia. And the U.S. has acquired territory in the not-so-distant past, right? We bought Alaska. So it's not totally as insane as, maybe the sort of intellectual elite in the Northeast thinks.
Yeah, it's not out of the question. I mean, these things, have happened in the past. You only have to go back, 5, 6, 7 decades to see, both the USSR and the British Empire and as well as American colonialism, as this is something that has been done. The difference now is you have, sort of these countries coming out and saying, look, this is not on the table. Greenland is not for sale. It won't be for sale, is what Denmark said in recent days, as well as, Canada. Trump has really trolled Canadians over the past several weeks, including Justin Trudeau, saying that, hey, why don't you just become a 51st state? Trump probably hasn't thought through all of the implications of that. That would probably mean 2 more Democratic senators, which would mean he would lose his Senate majority. But Canada has said, look, this is not on the table. You saw a very strongly worded statement from Trudeau yesterday.
Well, you'd be able to get into Canada without a passport. I will say
Trudeau, he's done.
That's true. The last time we expanded American territory was in 1947 when President Harry Truman oversaw the acquisition of several small Pacific Ocean island chains from Japan in the aftermath of World War II. So never say never, I guess, Laura, but...
Alaska
too.
Yeah.
But I'm saying the last time it happened was 1947.
Oh, those small.
They were little.
But
in any
probably
case,
nice, though.
Probably. I mean, I don't know.
Maybe strategic.
Maybe we can visit them. In any case, Laura, what did we hear Donald Trump say about tariffs yesterday? Was there anything new on that front there? Because that's where a lot of investors are focused right now.
Yeah, a couple new things. One, he said that he would threaten Denmark with tariffs over this Greenland issue. He didn't get into specifics, but he said they would be high-level tariffs. And this is, something that we know that Trump sort of thinks about. He, sort of throws out the threat of tariffs as a negotiating tool, and he is very willing to follow through on that. He doesn't always. So this is, again, where this gets to be sort of a geopolitical, kind of dance here of, other nations trying to figure out exactly what Trump means, what he might follow through with. He doesn't need Congress to do any of this. So if he decides he wants to do it once he's president, all he has to do is basically sign a piece of paper saying that tariffs are into effect. We also really saw him double down on both tariffs for Canada and Mexico. He had talked about this several weeks ago and mentioned, really connecting the threat of tariffs to the flow of fentanyl and illegal migration across the U.S. borders. He really sort of said that, look, this is coming. This is something that he, he sort of really escalated the language there.
Laura Davison, we thank you so very much for your time covering all things U.S. politics for us. Now, still ahead, Meta CEO Mark Zuckerberg, yes, he made some news yesterday announcing the end of fact-checking on his social media platform, but people were watching what he was wearing instead. We're going to talk about that more in Social Climbers next. This is Bloomberg.
All right, it's time now for Social Climbers, companies making waves this morning. And first up, Flutter It's the world's largest online betting company. It said that earnings at its FanDuel brand will be sharply lower after U.S. football gamblers enjoyed an unprecedented winning streak. Flutter said that the NFL season had the highest rate of winning NFL favorites in almost 20 years, and that's bad news for Flutter, but shares shaking it off at the moment. Next up, we have shares of Helen of Troy. They're falling. That's after the parent company of consumer brands such as Hydro Flask and Vicks said that a weak winter season hit its sales in the third quarter. The sales decrease was primarily driven by a decline in its beauty and wellness line. And finally, Meta CEO Mark Zuckerberg reportedly wore a rare $900,000 watch. You can buy so many really nice horses for that sum of money. That was as he announced his company's decision to end its fact-checking practice. The Swiss watch is said to take 6,000 hours to assemble, and only 3 models are made by hand every year. Some say it's a sign of Zuckerberg's stylistic evolution. Others are reportedly deeming it a midlife crisis. I'll leave that to you, the viewer, to decide.
Can I just, Katie, is it...
Go ahead.
Is it not more notable that he's wearing a necklace? He started wearing a necklace recently.
If we could get a photo of the man, we could really dissect.
I just don't... Is that a new thing? Did the kids do...
He's been wearing a necklace for a while. He has done this rebrand. Here he is. I think he might need a haircut, but in any case, there's the watch, there's the necklace. He also's got a t-shirt on. In any case, let's take a check on these markets right now. It's been a rough day, a rough start. Of course, you can see the S&P 500 down about 0.3%. Same thing if you take a look at big tech. The bond market, relatively well behaved right now, but don't go anywhere because coming up, we're going to keep talking about luxury items, and that is with Rolls-Royce Motor Cars CEO Chris Brownridge. He joins us next. This is Bloomberg.
Rolls-Royce Motor Cars didn't sell more vehicles last year, but it made more money. At 5,712, BMW's pinnacle luxury car maker sold about 300 fewer total units than in each of the 2 previous years, but at a higher average price on a 10% jump in bespoke deliveries. As a result, Rolls-Royce is now investing an additional $375 million in its Goodwood manufacturing facility to meet rising demand for personalization that can drive individual transactions deep into 7 figures. Joining us now is Chris Brownridge, the CEO of Rolls-Royce Motor Cars. And Chris, this is, I think, a fascinating strategy move that you have made with the company. And it goes beyond just sort of paint to sample or picking a different leather. Tell us about some of the personalizations that people are doing.
Well, Matt, first of all, good morning, and thank you for inviting me onto your show. Last year was a tremendously successful one for Rolls-Royce, and you know that at Rolls-Royce, we make handmade bespoke luxury goods for our clients, and we strive to deliver them an extraordinary experience. And our bespoke collective team is right at the heart of our business. What we aim to do is create a masterpiece for each client. And the investment that we've announced today is all about facilitating that through creating the capacity and the space within our manufacturing facility at the home of Rolls-Royce in Goodwood so that we can deliver those projects.
So, but your customization goes beyond the customizations of almost any other car maker I can think of, certainly any one that produces in the hundreds or thousands of cars a year. What kind of investment are you making, and what is it going to allow you to do to these cars?
Well, Matt, at Rolls-Royce, bespoke means something very profound. It can be something as simple as having a hand-painted coach line on your Rolls-Royce that perhaps has your family motif on the outside of your motor car, or perhaps embroidered in a head restraint. It could be something more profound, celebrating the relationship you have with your partner, where the headliner on the interior of the car, which uses fiber optic cables to recreate a constellation of stars, it could show the constellation on the night that you met, in the location that you met. Or it could be something much more profound, whereby, for example, last year we made a car for a very famous client where the interior of the car used silk paneling in the headlining and the doors, where we embroidered a particular flower and hand-painted that flower and created a fascia panel, a dashboard panel inlaid with mother of pearl because it reminded them of the different homes that they own. So the diversity is extraordinary, and this extension will mean that we've got more capacity and space to deliver these projects because they are very time consuming, and it comes hand in hand with us expanding our network of private offices. Now at Goodwood, the home of Rolls-Royce, our clients come to us and they meet the design team, but not every client can come to us. So we've opened private offices in Dubai, in Shanghai, in Seoul, and of course in New York, where our designers are working nearer to the clients and they can bring their ideas to life. So effectively this network of private offices is driving a growth in the demand for these wonderful creations, and that's why we're preparing the facility in Goodwood.
What's your fastest growing market right now? It's interesting to hear more about the private offices. Certainly the Middle East is an area that a lot of investors have been looking at for growth. But is there one area more than others that you see more potential? And what are the demographics driving that growth?
Well, the wonderful advantage Rolls-Royce has is it's got a heritage of 120 years, and it's famous throughout the world. And our business is present throughout the world. So we have clients in every corner of the world, across every region. Of course, the USA is our biggest region, and we have a strong client base there. But across the world, we've seen significant growth in Europe and the Middle East, and also APAC this year. And the great thing is we're seeing in every corner of the world significant demand, particularly for our bespoke creations.
And Chris, I want to talk a little bit about the future here. Obviously, when it comes to EVs, you have Spectre. It's selling very well. You talk about in your release how this manufacturing facility will help your transition to an all-battery future. It's been interesting watching the trends, though. You see hybrid selling very well in sort of the normal market, the non-luxury market, and even in the luxury market. Could a hybrid ever be in your future?
Well, I'll start by talking about our experience with Spectre this year. Now, Spectre's a super luxury coupe, an absolutely stunning motor car. And in 2024, it was the first full year that we were delivering this motor car to our clients. And it's been a very successful year for Spectre. In fact, it was the second most demanded Rolls-Royce, which is extraordinary. And what we have with Spectre is it's the first Rolls-Royce to use a very highly developed electric powertrain in a Rolls-Royce. And our clients have told us that what this does is it amplifies all the characteristics that you'd expect of a Rolls-Royce: the silence, the waftability, the ease of driving, and that magic carpet ride. So the feedback that the most important group our clients have given us is that they think this is a wonderful Rolls-Royce. And with the data backs that up, the client satisfaction with Spectre is the highest of any of the motor cars that we produce. So that's a really encouraging start. You know, at Rolls-Royce, we strive for perfection, and our powertrains are the finest for the motor cars that we deliver to our clients. And of course, we already have the wonderful V12 combustion engine. With Spectre, we have our first electric powertrain, and both of them deliver the best possible experience for our clients. We wouldn't deviate from that because we always want to deliver the best possible solution. And Spectre's told us very clearly that when we combine this new technology with a Rolls-Royce, we can deliver the best car in the world.
I can confirm that the V12 is a highly enjoyable powertrain. I have not driven the Spectre yet.
Okay.
Chris, are there any holes in your product offering? I mean, you've got Cullinan, which is your bestseller, the big SUV. Spectre, as Katie mentioned, has done very well. I tend to prefer Ghost or Wraith, more drivers' cars. Phantom is the one that we're looking at now. Or that's Cullinan? That's Cullinan. Phantom is the one you want if you've got a chauffeur. Is there anything that you need to add to that product offering?
Well, we have had a very busy year in 2024 where we introduced the Spectre for the first full year. And of course, we introduced the Cullinan Series 2 and Cullinan Series 2 Black Badge, and also the Ghost Series 2 and the Ghost Series 2 Black Badge. We've had a very busy year, and we have a very, very strong core product offer. And all of our motor cars are like a blank canvas for the bespoke offer that we provide to our clients. In terms of future products, I won't give any secrets away right now, but of course, there are always exciting things that are coming down the line.
All right, well, I'm excited, and that's for sure. Rolls-Royce, really the pinnacle of luxury vehicles worldwide. Chris, great to have you on the program. Chris Brownridge there of Rolls-Royce Motor Cars, owned, of course, by BMW. Coming up, a case for healthier snack options. The March Group founding partner Harold Schmitz discusses how AI is helping to achieve that, which, I mean, that's a tease. I'm going to stick around
I'm
and
excited
figure
to
out.
find out how those two relate.
What does that mean? This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And studies show that people continue to eat more snack foods even as they struggle with weight gains that affect their health. Human psychology is fascinating. David Weston spoke to the March Group founding partner Harold Schmitz about how AI is helping to create healthier snacks.
What AI does is it enables businesses, when it's applied properly, to do things better, faster, and more cost effectively. And developing new food products is very difficult. So food is actually, from a chemical perspective and biochemical perspective, it is incredibly complex. So when you think about the raw materials that go into making a food, these are natural products and there's thousands of molecules in those ingredients that then need to be manufactured, processed and manufactured into something that tastes great, is affordable, and can be scaled up. And so what AI does is it actually makes this incredibly complex mixture of chemistry, biochemistry that then goes through food processing. It actually makes it understandable. So product development can happen exponentially faster in order to create exponentially better products that are more cost effective for consumers in the marketplace.
Do you have your own model or models? And if so, what are you training them on?
So in the food product development space, what we have to do is we have all these different data layers. So it's one data layer are the molecules, the chemistry that's in these ingredients that we're bringing together to form into a food product. Another data layer might be the temperature of the process that happens along the food processing. Another could be the pressure and steam and so on and so forth. So there's a lot of different data layers that go into making a new food product. And the only way to actually create accurate predictions about what could happen, let's say how I could take a high-fat, high-carbohydrate format, like a savory snack, that would be less healthy for consumers, and convert that into a higher protein, higher fiber snack that would be more healthy for consumers, then what we need to do is actually have data assets that are, or the training data sets that you just mentioned, that are in the house with the food manufacturer. And those are actually the training data sets that they run their own experiments over and over. And then those training data sets enable us to understand how to make healthier snacks that taste just as good and are just as affordable as the less healthy snacks where they came from previously.
How do you afford the compute that you need to be able to run these models?
So in order to actually afford the compute power, the first principle is the early stage startup company cannot be an AI company that actually has the compute power within itself. It needs to partner effectively. And so in the business, in the business marketplace, there are great AI providers and great compute power providers. And so, they want to do business and they want to work with companies who are going to grow into something that's going to be, a bigger revenue stream for them.
And that was Harold Schmitz speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
It's hard to pick your favorites. We announced 3 chips. We announced a brand new AI, a world foundation model, a first of its kind. And we announced our work in 3 areas in robotics.
Right.
And they're all important.
And that was NVIDIA CEO Jensen Huang speaking with Bloomberg Technology co-host Ed Ludlow. And I'm thrilled to say that Ed joins us now from CES in Las Vegas. So we heard a lot of things, of course, in your interview and also during a live Q&A that he did with analyst Jensen Huang, and his comments there spurring a huge move in quantum stocks right now. He said that maybe we're 15 years away for very useful quantum computers. But what does very useful mean to Jensen Huang?
Well, supercomputers and quantum computers are different technologies, right? A supercomputer is coded in ones and zeros. Classic. That's the understanding of most computer science. Quantum computers rely on particles called quantum bits or qubits that are particles that can be in any state at any time. They are better at very complex mathematical computations that you can just run exponentially, whereas a supercomputer, which is basically what NVIDIA sells, just focuses on a more narrow task, training a large language model. And Jensen is authoritative, right? This last fiscal year, his company will sell $100 billion worth of supercomputers. So if he's out there throwing shade at this technology debate, quantum versus super, and saying, I don't see it happening for 20, the market reaction is kind of understandable. And as you guys may have covered in the show over the last year or so, some of those stocks, of quantum stocks I'm talking about, are pretty volatile anyway. Some of them, many of them pre-revenue. It's there's not a really clear timeline to market.
I want to say, first of all, that I have missed you, Ed. And I'm glad to have you back on our air, even if
I missed you
it's only
too.
for a couple days. Also, love the glasses. I want to ask about cars.
Thank you.
You obviously major in tech, but you minor in automotive. And at CES, it feels like that minor kind of takes over. You spoke with the head of Scout Motors yesterday and asked him about the potential for no EV credits as they enter this market. Here's what he had to say.
Look, we've always been braced for it not to be there. So we never sat on it. It would have been a nice cherry on top, if you will. If it was there, it would have been helpful, obviously. But no, as I said, you can't sit a company in a business case on legislation that may or may not be there,
Scott,
particularly in these times.
So, maybe their product doesn't need it. Maybe it's a different market group, target market group that's buying the product. But also, they have introduced a range extender, making the EV, the Scout EV, essentially a hybrid, and they've gotten massive orders for that version of the vehicle, right?
Yeah, I think the news from that interview is that more than 50% of the reservations are for the range extender. So the way that I think about extended range EVs is that they're battery electric cars that have a supplementary gas engine to top off as you drive, as opposed to a sort of a hybrid where it's a gas engine the other way assisted by a battery. All of the automakers are here, and they're all thinking about Trump because of the proximity to the inauguration. And, we don't actually know a lot about Scout. I can tell you that Volkswagen are supremely confident in the Scout project, and they are backing it to the tune of $5 billion overall. But they're 2 years away from bringing a product to market. And so how can you plan for a vehicle at a certain price point now without knowing what the future holds? And I think his point was that they expect it to sell in the high $50,000 range based on a scenario where it is not aided by a consumer tax credit. Many of the automakers plan as such. And I think the consensus here, at least from the executives I've spoken to, and I've spoken to many, is that Trump will take that away.
Ed, we thank you so very much. This is going to be a very, very, very big story this year, particularly with how much capital has been flowing into the space. Ed Ludlow in Las Vegas at CES. We're also keeping an eye on another big interest for investors, that is Fannie Mae and Freddie Mac. The government-backed home loan giant soared over 200% since Trump's election, largely because of Bill Ackman. The Pershing Square founder is betting that the U.S. government will unwind its stake in Fannie and Freddie and that they'll be listed 1,200% above his average purchase price. Joining us now for more, Bloomberg's Nora Melinda. Your story is the #1 most read on the Bloomberg terminal right now. It's easy to see why. This is something that investors have talked about for many, many years. Easier said than done. When you have a 30-year mortgage that's flirting with 7% still, regardless of rate cuts, how difficult will it be to privatize Fannie and Freddie?
I think that's the question. And as you mentioned, it's a very challenging task. It's a very tall order that we're working with here. And especially because it's largely dependent on politics and what the environment is looking like. As I've been speaking to sources, many people are saying that
it's typically a bit more of a conversation under a Republican administration. And specifically, we have President-elect Trump that's going to be coming in. And during Trump 1.0, he actually was interested in potentially bringing them out of this conservatorship. And so we are seeing a massive rally coming off of the fact that people assume that if he has more time to do so and he has 4 years ahead, that there is potential that we could see this happen.
What does the process look like? I mean, is it something that Trump could do? Does Congress have to act? It's more complicated, I think, maybe than it seems at first blush.
It's definitely very complicated, and I think that that's something that it is a pair with Congress. It's also Trump. But it's also about how do these companies look when they come out of it. I mean, of course, when we're thinking about what Bill Ackman is saying in his tweet, he's talking about the idea of an IPO. Now, these companies have been under conservatorship since 2008. So they've been under the government purview for quite a while here. And that's something that if it were to come out, people are wondering how they would actually do. I mean, of course, if you look at the stock, it's very, very low. But we've seen an extreme rally that people are comparing to potentially a meme stock rally.
We should point out that it would be a secondary offering, not an initial public offering.
Right.
Because the stock trades already.
This is very true. This is very true. But if that were to happen, and we did see this happen, that would be about 1,200% above what Bill Ackman's the initial purchase price was. So that would be an extreme gain, of course, for him and for others that decide to hop in on that trade.
So you could say that Ackman is talking his book here, but I think he's been pretty upfront about that. Let's talk about timelines. As you said, this would be a thorny process. This wouldn't be the first time that markets got really excited about a story and then had to wait for a little bit. But what are sources saying? What are analysts saying about when this might actually happen?
Right. I mean, so Bill Ackman does talk about late 2026. Now, analysts, I have been hearing people a bit more bearish about the idea of this actually occurring, but it depends on which side of the aisle that you're sitting on in terms of how this could potentially pan out. But it could take a while, and I've been speaking to sources that are saying that it wouldn't necessarily be a step one out of the gate thing that President Trump is interested in doing. It would likely be later in his tenure.
All right, Nora, great reporting. Stay in touch. That, of course, is Bloomberg's Nora Melinda. And it'll be interesting to see where that actually falls on still President-elect Donald Trump's priority list. But in any case, let's take a look at these markets right now, of course. You can see it's been a choppy trade. We're talking about small moves overall. But, of course, this follows a big wipeout in the stock market yesterday. And the S&P 500 not able to get off the ground, down about 0.1%. The NASDAQ 100, we've been flirting with unchanged territory. Now it seems like we're maybe materializing into maybe a decisive move lower, but still small moves. And then you take a look at the bond market, and it's quiet right now. But that's deceiving because, guys, you think about this incredible move that we've seen at the long end of the Treasury yield curve, particularly when it comes to 10-year yields. We're on 5% watch, but Matt, the 20-year Treasury yield is already at 5%.
Was up and over 5%. I know this is a stocks-focused show. Obviously, we air over the market open, so we're looking at stocks. But I've been pulling up WB more and more often on my Bloomberg just to watch and see not only the 20, but also the 30-year get to 5%. It's trading at 4.927%. And these yields are higher than they've been, with the exception of one other time in recent history since the great financial crisis.
There's a lot of spillover effect. On one hand, you're looking at that 5%. Is that the new danger zone, guys?
Feels like it.
Right.
Every guest we have on, they told us a couple months ago that 4.5% was the danger zone. Last month they said 5%. Today we heard from Abby Yoder 5.5%. So they keep pushing that zone further away.
But they're also just different sectors, right? You think about that longer-term rise in interest rates. That's the mortgage market that's being impacted more. Then consumer discretionary could be the spillover. So a lot of those spillover effects under the surface, I suppose.
All right, coming up tomorrow, we will have special coverage here on Bloomberg Television at this time of President Carter's state funeral. That starts at 9 a.m. New York time on Bloomberg TV. And remember, there's no trading tomorrow. The New York Stock Exchange has stopped trading to honor the legacy of President Carter. This is Bloomberg.